Welcome back, David. How was Italy?
It was great. It was great. Went to Lake Como and Cinque Terre, and it's quite a sight to see. If you've never been there, it's something very unique, and I think something that should be on a bucket list.
Awesome. Well, let's jump right in. Now that you're back with us, let's go over last week's weekly market letter, shall we?
Okay. Well, last week we had a little bit of a kickoff for earnings, and they kicked off with strong numbers from the money center banks, pretty much across the board. There were some concerns about credit quality in the regional banks, which capped off the momentum in the stocks for a little bit. But the gains pretty much were widespread. Every sector was higher last week. It was led by REITs, consumer discretionary, consumer staples, and technology. Once again, AI related and big cap technology stocks are where you want to be. But we also last week saw the secondary indexes, which I like to see lead the market higher, and usually they'll lead it lower also. That includes the Dow Jones Transports, the Philadelphia Semiconductor Index, and the small cap Russell 2000. We saw those three indexes actually outperform the NASDAQ and the Dow and the S&P 500. So that's a plus. Now, part of last week's volatility, and it was quite volatile. In fact, we had some days where the Dow Jones was had daily intraday swings of almost 1,000 points on several days, more 500-600 points. And it seems to be all kind of a tit for tat headlines between the U.S. and China with trading. They're throwing things back and forth. It makes it a little bit hard to trade off of that, especially when you're longer term. You've got some nice profits, I'm sure. You don't want to see them get erased by a headline which says, we're going to put more tariffs on China or something like that. Because these last several months and all of this year, actually, you probably have made some pretty good money in the market, and you don't want to see it dissipate. So anyway, we also saw last week, we saw yields tick a little bit lower. We saw the 10-year Treasury dip below 4% for a little bit of a move to safety towards Friday. Then the rate ended up at 4.07, and the 2-year slid down to 339 before closing at 346. And they're both hovering today right around that 4% and just below 3.5%. That still is kind of where that's been holding pretty steady here now for maybe a week or so. So we want to kind of see how that is. Now, one thing I did notice, I know the 30-year mortgage came down just a little while ago when I looked at it. It was 6 and an 8. You would think that would start to help the housing stocks a little bit more. They're not getting quite the boost that I would expect, but eventually that should come to fruition on that. Okay, now the technical condition of the market was kind of neutral position. The indicators were mixed. Part of that was because of the previous Friday's big sell-off that caused the MACD, which is a short-term trend gauge, to slide into some bearish territory. And it also slowed the momentum. Often we look at the 9-day or 14-day RSI for signs that the market momentum is either picking up or slowing down. In this case, it moved down, and it kind of around 50 on the oscillator charts on that, which is neutral, but it is kind of tipping up again. So with today, you're going to see a nice big jump in momentum today. As I'm speaking right now, the market is up. The Dow's up about 530 points, and NASDAQ is up 1.5%, 329 points. We have a lot of new records on the major rate averages today again. And today, the reason is, again, just more progress on China trade talks. That's a big issue for the market right now. We also have more AI-related buying. We had Apple get a couple upgrades today. Their iPhone 17 is outperforming analyst projections in China and the USA. So Apple actually was making a new high here earlier today. It probably is. Today it was up like $11 or something like that. So that's strong. We did see a nice little bit more of a pullback in the VIX today. Again, we're back down here around 18.5. Now, the last week at some point, we saw the VIX, which is the volatility index, and it shows how much they call it the fear index or fear gauge for traders. The higher it gets, the more fear there is that we could have a market pullback or a bump in the road here. We're starting to see it come back. It means they're feeling a little bit more comfortable. But part of that is the trade talks kind of upset investors and traders. But on the good side, it's hard to compete against a Federal Reserve that is going to do more easing. You just don't fight the Fed unless they're cutting because the economy's fallen off a cliff, which we're not. Earnings have been strong so far. There's no reason to think that things are just going to roll over here. The big tech earnings will be coming out this week. In fact, starting tomorrow, we're going to get GE Aerospace, Coca-Cola, Lockheed Martin, Netflix will report tomorrow. Wednesday, we have GE, Vernova, IBM, Tesla. Thursday, we get Blackstone, Ford, Intel. And then Friday, again, like I just mentioned, the BLS, they brought them back. They're going to release the CPI for September. Now, the headline number right now is 3.1% year over year. That's what they're looking for, which would be 0.2 of a percentage hotter than it was in August. And then core, they're still looking at 3.1% year over year, and that would match where we were in August. So that will be the last key economic data point the Fed will be looking at before they congregate with their FOMC meeting for October, the following Tuesday and Wednesday. And the market still has about a 97, 98% probability that the Fed will, cut another quarter point. Now, one of the things, of course, if they would surprise the market, Powell does not want to just come out here and blindside the market and say, I'm not going to cut it after October. That he'll just say we'll be data dependent from there, and we'll see how that goes. But unless there's something that comes out like the CPI comes in much hotter than what they're looking for, something like that, you can expect to get that rate cut. And that will also, that'll be a little floor underneath equities in case we get other hiccups in the trade talks. That will keep buyers coming in and buying the dip all during the week here. Now, also last week, underlying market breadth, it improved. We had the NYSE advanced decline line, which is a leading indicator of market direction. It moved higher. But I've mentioned several times that you want to keep an eye on that. And if you go over here on the market recap section we have, the reason this is going to be important for you to keep an eye on, maybe just check it out, is historically, if you're a market technician, the AD line, especially the NYSE AD line, will top out a couple weeks before the market tops out. Okay, we last made a new high here about 3 weeks ago. So that's something that's not a reason to sell, but it is a red flag, okay? I can enlarge this thing over here so you can see it over here. We're going like this. Now today, I think we're up about 1,500 units on the AD line, which is going to push it back up here. But if you see this starting this week, starting to make a new high, that would just be confirmation that the market is probably taking another leg higher here. But we'll have to see on that. So that's something to keep an eye on. Also, we've had a pretty nice expansion in the number of new highs and new lows. Surprisingly today, and I'm actually just checking this out right now. So today you have the market making a new high on the NASDAQ. It made 314 new highs on Wednesday of last week. We've only got 191 new highs today when you're making a new high. That's something we call negative divergence. In other words, we're making a new high today on less stocks. The number of stocks making a new high is less. And on the Dow Jones, okay, you had 137 last Wednesday, which is not a big number, but we're only at 69 new highs and 20 new lows. That's another red flag. That's another point of negative divergence, which you want to keep an eye on. And you can see over here on this new high, new low thing here. Again, you see this thing starting to fall off. That's not a good sign. You want to, over here, when the market was making new highs all through the end of the summer into September, this is a pretty healthy new high, new low line, which is confirming that you got a lot of stocks making new highs. That's what you want to see when the market's moving higher. You don't want to see this coming down like that. So that's 2 points, 2 areas here on this page that you kind of, make sure that you're maybe looking at it once or twice a week just for confirmation of the market's move. I can't stress that enough because these internal indicators are things that, they don't often talk about on TV, but you can follow here on MarketEdge to make sure that the move is being confirmed by what's underneath the hood a little. Okay, and finally, we talked a little bit last week about investor sentiment. It's still bullish, nothing big. The previous Friday's sell-off did rattle retail investors who have been kind of leery about this rally all summer. In fact, we saw a jump in 12.2 percentage drop in the retail bulls, and it's back again below historical levels. That's the first time in 5 weeks, but remember, there was about a 20-week period where the retail bulls remained below the historical levels. They just weren't buying this rally. We'll see what happens here with that indicator. When those sentiment indicators get too bullish or too bearish, we started looking at those as contrarian indicators because they usually, when the crowd moves one way or the other, it's just generally good to go against that crowd. Like Warren Buffett talks, when everybody has fear, you get greedy. When everybody's greedy, you start getting fear. And one last thing that I did want to mention about something that happened last week. A lot of times when you get near a market top and sometimes even a market bottom, but especially a top, you'll start to see increased volatility in the major averages. In other words, intraday high and intraday low covering 5, 6, 700 points. Those big swings are things that happen at market tops. So just be aware of that also. A boring market usually will, keep on going higher, and you never short a dull market. So these wild swings here are in the major averages or something, again, that are just a sign that you want to be a little bit cautious because historically they have been there when when the market started to roll over. And I don't want you to get caught just thinking this thing's going to go up forever, because they don't. And when you have something that's this strong, a lot of times they do end up in a bad way. It's not pretty when they get going. So anyway, that's going to be it. The concentration again this week, the government's closed. That doesn't really seem to be upsetting anybody. That just means they can't be getting anybody in trouble. But keep an eye on earnings. So far, so good. They're actually beating estimates. And then we'll get that BLS number on Friday, which will be the last big number before the Fed meeting next week. And I think as long as you have that rate cut on the horizon, it's going to be hard to knock this market down. You may have some intraday volatility off of some of these stocks, and you're going to have guys coming out on the TV or whatever saying, hey, we're in a bubble, you need to take care of this, and this has never happened before. But a stock or index or market can stay overbought for a long time. Just because something's overbought is not a reason to sell. So just keep aware of that. And if you're long, don't just go to sleep on it, but I would just let things ride for a little while on here. That's about it for today.
Great. Anything else you'd like our viewers to know before we go?
Yeah, there is one thing. Uh, you'll notice that the CTI count will change to a negative configuration this week. Now, that also is not a reason to sell. It may keep us in a normal market posture, depending on what the market or momentum index is and sentiment index. But you have to remember these waves in the market are like sine waves. And when you think of a sine wave, halfway through it goes up, then it starts to turn down for the last half of the wave. But in reality, especially in the market, that peak in the sine wave can be leaning to the left or it can be leaning to the right. Now, normally when it leans to the right, that's a bullish sign for the market. That means that the peak is coming later in the cycle, which means you'll have less of a pullback in the cycles. So at this stage, when you see that we have a negative configuration, that's just as another sign that maybe we're getting close to within maybe a few weeks where you may just want to start, clearing a little bit off the table. I would just be thinking because you're overbought that you want to jump out. Let these things ride, because this is a market that you should have been making a lot of money in. If you were sitting on the sidelines thinking that it was in a bubble or something like that, you've missed a heck of a ride for your portfolios. And what we want to do is we just want to try to make as much money for you as we can. So that's about it for this week.
Great. Well, thank you so much, David. If you have any questions for David or anyone on the MarketEdge team, feel free to send us an email to support@marketedge.com or drop us a comment if you're watching on YouTube, and we'll get back to you as soon as we can. Thank you so much, and we'll catch you next week.
All right. Bye-bye.
Bye.